Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, shares of Super Microcomputer, ticker SMCI, are up 119% since highlighting why I bought the stock on November 18th. On that position of 15,000 shares, I'm now up $219,000, but I see daily in the comments investors asking, is it too late to buy SMCI stock? Are the big returns over? The good news, it is not too late, and I'm going to show you how not only to get the stock at a 40% discount, but how to make a 55% return over the next year, along with important updates to shares of Airbnb and Broadcom. But first, if you've ever wanted to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. Folks, these are the stocks I'm following in major multi-year themes, with one of the picks up 100%, and the group up an average 94% last year alone. That report is totally free. You'll see the first stock immediately. They're going to email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link in the description below. Back to Super Microcomputer, ticker SMCI, and this stock is up 119% since our video last month. But I gotta warn you, the next month could see some weakness as investors see problems that drove that 85% crash this year aren't really cleared up as some anxious investors and the media are suggesting. But I am holding my 15,000 shares worth over $633,000 anyway because the upside is still much higher over the next year. I want to cover those near-term risks first and make sure everyone out there knows what SMCI is still up against, along with my price target for the year and a strategy that could lower your risk but still get a 55% return upside on the stock. Now again, SMCI has been booming since my November 18th video on exactly the reasons I pointed out, but the rally was confirmed with a 30% jump when the company's independent review found no evidence of fraud. Investors cheered the finding, and even some big money hedge funds have piled back into the stock, with the market acting like all of Super Microcomputer's problems are over now. But the company is not out of the woods just yet, not in the short term anyway. The problem is, while it does appear that SMCI is cleared to put together its late 10K and 10Q filings and has an accounting firm to audit them, it is yet to actually do so. We did hear late Friday that the Nasdaq has given the company until February 25th to file those late reports. That should give SMCI all the time it needs to file, but it just hired its accounting firm, and it's going to be at least a month to put all this together. In the meantime, the company is still also fighting a lawsuit by a former employee that alleges some of those accounting issues and questioning by the Department of Justice, probably over alleged sanctions violations with Russia. So there is still considerable headline risk here, along with just that wait until they can file those late reports. Knowing how impatient investors and the stock market can be, the stock is likely to remain volatile and could see a sell-off over the next month. But that volatility is also going to be your opportunity. As I've been arguing on the channel, Supermicro is really the only pure play on that data center build-out theme. The company does one thing, and it does it very well, providing those server solutions capable of running the intense computing involved in artificial intelligence. Now, competitors Dell and Hewlett-Packard Enterprise both reported giant revenue growth in that server segments over the last couple of weeks, showing just how strong that demand is, but both are being held back by their other segments in their businesses. SMCI doesn't have that problem. It is all growth. I've already highlighted in prior videos why the short seller allegations are really a non-issue, and it looks like the market has finally come to that conclusion as well. With the shares up more than 100% over the past month, we need to build a price target range to see how much upside still might be left. We can see in estimates here, the company is forecasted to see sales growth by 67% this year and 20% next, which I think is ridiculously low on that growth theme that we're seeing in the peers. Just assuming that $30 billion in forecasted sales though, and using valuation multiples history here from Morningstar, we see a low valuation of around 0.37 times its revenue when the stock was trading really at that peak fear after the 2018 delisting. Now, a delisting this time around is likely off the table, and the shares traded for 0.74 times revenue in 2022 after getting relisted on the Nasdaq and getting some of that investor confidence back, so we're going to use that as our low point for our price target. We can look to more recent prices for an upper end on that target though. With the AI demand starting to grow last year, the shares grew to a valuation of 2 times revenue, and then to as high as 6 times sales in the surge this year that took the stock to $120 each. So with that, we can build a range for SMCI stock from 0.74 times sales of $30 billion which would be a $22.2 billion market cap on the low end, to a more appropriate 2 times revenue multiple, which would be about a $60 billion market cap. And with the shares just over $43 each, the market cap or the total value of all those shares is around $25 billion. Now that's right around our low estimate using that 0.74 times price to sales multiple. So in this case, the stock could actually flatline over the next year. But I'm going to show you next how to still get a solid double-digit return even on that. But then on that $60 billion market cap, on that 2 times price to sales multiple, we could be looking at $102 per share stock price, and that's not even the best case scenario. Remember, SMCI traded for as high as 6 times sales in March, so if it can put those accounting allegations, the delayed filings, and the lawsuit behind it, and show that real power of the sales growth, it could easily be trading for 3 or 4 times its sales, which would mean a jump well over $120 a share. But don't forget that remaining headline risk over the next month or two means the stock is going to remain highly volatile, bouncing up and down and possibly even trending lower until the company actually does file its late reports. That is actually a good thing though for investors still waiting to get in, because that high volatility means higher options prices and an opportunity to get a 55% return over the next year, even on our low target price around $40 a share. The strategy here is simple once you actually get the hang of it, though it might take a couple of times watching through this explanation if you're unfamiliar with how options or that covered call option strategy works. If you click through to the options tab on Yahoo Finance, and I'm only using Yahoo as an example here, you can do this on any online investing account. Here you change the date to January 2026 options. And here you scroll down through the call options, and remember, these give an investor the right to buy shares of SMCI for a set price, that strike price, if they pay a cash premium now. We're going to use the $40 strike options for our example as really that safe strategy, since that is our low price target, and the options are trading for about $18.12 as of the close on Friday. That is the amount investors are paying for the right to buy shares of SMCI for $40 each from now until January 2026. So the way that you use this to get your 55% return is you buy the shares and at the same time sell these call options against them. In a brokerage account, this would mean buying 100 or more shares of SMCI and then selling to open one call option contract, because remember, each call option contract is worth 100 shares at that $40 strike price. If you were to buy the shares at the current price of $43.93 each at the close of Friday and sell a call option against it for that $18.12 premium, collecting that amount, that means your actual cost is only $25.81, which is a 41% discount to the current price. Shares could fall 41% and you would still break even on this. Now, under this strategy though, if SMCI stays above our low estimate of $40 each by January 2026 expiration of those call options, the investor that bought that option from you is going to get them for that $40 contract price. You will have collected $40 a share on your $25 cost basis, or a 55% upside return. Now, of course, remember the downside to all of this is if the stock does shoot higher to $100 a share or more, you're still on the hook to sell for $40 each to that call buyer. You can offset this risk by selling maybe a higher strike option, say the $50 strike price here for $14.35 each. That would instead lower your cost basis in the stock from the current price down to about $29.58 each, which a 33% discount there, while still keeping your upside open to about $50 a share, or a 69% return. The alternative is you could always just buy the shares outright at this current price. You leave yourself open to any short-term sell-offs, but you do keep unlimited upside if the stock rallies again to $100 a share or more. Now, I like using the option strategies because with the volatility in the stock so high, those option premiums you can collect make it a no-brainer. The analysis I've shown in our previous videos on SMCI shows the stock is worth well over that $25 cost basis. You can get it right now with that option strategy, likely worth 2 or 3 times that price, and even a low-risk strategy can net you a 55% return or higher. Looking now at the stocks I'm watching this week, Airbnb Inc., ticker ABNB, could see a strong catalyst to the upside soon in a bill introduced to the New York City Council that could ease restrictions on the company's biggest market. If passed, the bill could reverse a prior rule that saw Airbnbs in the city shrink from 23,000 in 2023 to just 3,700 currently. Last year, pressure from the lobbyists in the hotel industry pushed the city to limit guests in a person's home to just 2 at a time, and only with the owner present. The introduced bill, though, would increase that limit to 4 people, and the owner wouldn't need to be present, really opening the city up for that short-term vacation rental market. The bill does have cheerleaders on the council, but also faces millions spent by the hotel lobby to protect it from competition and keep those hotel room rates high. Shares of Airbnb are down 6% from its 2020 IPO and up just 2.4% over the last year. The company is still expected to grow sales by 10% this year and next. They aren't particularly cheap here, but that bill's passage in New York could see the stock jump higher. Also watching Broadcom Inc., ticker AVGO. It's going to be reporting its earnings on Thursday at the heart of really that data center boom in enterprise software and artificial intelligence. Broadcom not only provides automation software and cybersecurity, but also the networking equipment that is going to be the next bottleneck in the AI theme. Earnings are expected up 25% in the third quarter on 55% revenue growth from last year, and for revenue to grow 44% this year. Now, as much as I love the company's position and future, like most stocks right now, it is not cheap. Shares are trading for 137 times on that price-to-earnings basis and almost 17 times sales, so it is going to need to show those strong growth forecasts to continue to hold up that price. The stock is up 96% this year, and the momentum is still to the upside, but I'd hold some money back just to buy on any dips. Humana, ticker HUM, is the second worst performing stock in the healthcare sector, the worst performing sector over the last year. That could be about to change, and I bought $85,000 worth of this stock Friday just to be ready for that. Not only is the company the best positioned to benefit from changes to the Medicare Advantage program and a Trump administration stance on healthcare spending, the Center for Medicare and Medicaid Services, the CMS, is being forced to recalculate some of its star ratings for several insurers. The star ratings help determine how much an insurer is reimbursed for providing Medicare Advantage services. The CMS released new ratings in October, but was sued by several provider insurers, including Humana. Last month, a federal judge ordered the CMS to recalculate United Health's rating when it was ruled that the government had unfairly assessed the insurer's call center service. The ruling is a good sign that Humana's rating could be recalculated as well, adding to that upside that I'm expecting from those broader Medicare Advantage changes over the next year. Showing you that bigger picture here with the Sector Spiders sector tracker. It was the growth sectors and nothing else last week, with just 3 of the 11 stock sectors closing higher. Investors really got a sense of that TINA. There is no alternative in the bull market, with stocks in technology, consumer discretionary, and communication services the only ones posting returns for the week. Now, that is not a healthy sign for the market if gains are not well distributed, showing that investors are really only piling into a small segment of the market rather than investing across the market because of some broad economic health. Still, there doesn't appear to be any near-term catalyst to a sell-off, so investors shouldn't fight the trend in these hot sectors. Looking at another trend here, energy stocks have now given back 2.7% over the last month, the second worst performing sector. It's really that strong supply and fading geopolitical tensions bring the price of crude lower. Unfortunately, there is little to drive the price of oil higher, as still that weakening global economic growth is going to sap demand at the same time that strong oil production really oversupplies the market. Oil should have strong support around $60 a barrel, though, and oil companies are still cash flow positive as low as $45 a barrel, but investors are still going to be likely to see some of those stocks head lower. Now, for patient investors focused on dividends, staying in the sector can still yield good long-term returns, but understand there is likely more pain to come over the next 3 to 6 months for these stocks. See the stocks I'm buying for the next 30 years, my forever stocks, up an average 94% in the last year alone, and your free report with the link in the description below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.